And ironically, now what we're seeing is a little bit of a rotation. So some of those services seem like they're starting to exhaust themselves a little bit after a pretty strong period, whereas those PMIs, those manufacturing type of areas, seem to be reaccelerating. They're still at a pretty low level, but they look similar to how they look when they're emerging from recessions or emerging from near recessions. And so I wouldn't be surprised if we see that the next, call it 18 months is kind of an opposite story of some of these more cyclical areas kind of outperforming expectations, while some of these other areas that have done well over the past 2 years start to lag. And we see that in, for example, there's weak EV sales, electrical vehicle sales. There's a little bit of weakness happening in restaurants now. There's a little bit of weakness around the margins in some of these higher end categories that have been doing quite well, and a little bit of that rotation that's happening. That's kind of the main lens that I see it. We see it somewhat similar out of China. That's obviously another big macro impact on the global economy. They've been fairly weak for the past couple years, but they are showing kind of early green shoots, kind of early signs that they might be stabilizing at these low levels, largely because of their policy shift. And so I think that some of these cyclical areas, whether the U.S. or elsewhere, are probably starting to turn up even as other areas soften.
In a recent analysis by finance expert Lyn Alden, data reveals a notable slowdown in certain sectors of the US economy. Despite nominal wage increases, many individuals struggle to keep up with cumulative inflation, particularly in groceries, insurance, and housing. Mortgage rates are rising, impacting housing affordability. Meanwhile, purchasing manager indices indicate a drawn-down deceleration in manufacturing and cyclical sectors, with some even experiencing outright contraction. However, a potential turnaround may be on the horizon, as these sectors show signs of re-acceleration, suggesting an upcoming rotation in the economic landscape.
So basically, there's permanently more money in the economy now, and so people reliant on wages for income, many of them are having a very tough time because even though they did get higher than normal wage increases in nominal terms, it's been challenging to keep up with the cumulative inflation that's happened to things like grocery prices, to things like insurance prices, to all these different categories of goods, especially housing prices. You have higher prices, but also higher mortgage rates. Housing affordability is a challenge for a lot of people, and so that's a segment that's not doing particularly well. But those who do have a lot of assets, basically, ironically, what the Fed's doing is paying them a lot of extra money to not lend. That's essentially how these higher interest rates work. They're paying banks to try to slow down their lending. They're paying, in general, that money's flowing out, and so there are people that are receiving that. And that's the way that most of this wealth distribution works is that that's fairly concentrated. The large money market holders, the large T-bill holders, a lot of that is kind of concentrated in very cash-rich corporations, very cash-rich individuals, and so they're getting more on their dollars than they were in a low interest rate environment. And so if you're in a situation where you termed out your debt long term, and your cash equivalents are obviously much shorter, they're adjusting upward with tighter monetary policy. Whereas the federal government's obviously, like, ironically, in kind of the opposite situation. Their average debt maturity is only like 6 years. They do a lot of short duration funding, so a lot of their financing is under 2 years, and then they have this longer term that extends out to 30 years. But they're very front loaded in the financing that they do, which is different if you look at, for example, a company like Coca-Cola or any kind of blue chip corporate corporation. They're going to have on average pretty long duration debt. They term it out as much as possible. There's historically been a lot of demand for their bonds, whereas the federal government's not done that. And so a lot of this capital flow is flowing toward entities that have termed out their debt at pretty low fixed rates, but then have decent amounts of cash equivalents that they're actually earning higher yields on. While and that has a non-zero propensity to spend, meaning that that money, when they receive it, generally won't circulate in the economy as fast as like a stimulus check will. It still has a non-zero propensity to circulate around the economy, and that represents buying power, even as it represents a big fiscal drag for the government. And that's why that can be in a kind of nominal sense more structurally stimulatory, and a big chunk of that stimulation is the inflation component. So if you're on the right side of it, it feels good. If you're on the wrong side of it, it can feel pretty devastating. So over the past couple years, we've seen a huge slowdown in some of the more cyclical sides of the economy. So for example, I like to look at PMIs, Purchasing Managers Indices. It's kind of a big overall read on the rate of change of the manufacturing sector and some of those other cyclical sectors around it. That has been in a very long, drawn down deceleration, and for a period it was outright contracting. If you just isolated that segment of the economy, that was in recession. Um, and that was offset by a fairly strong services economy. So travel was booming, restaurants were doing pretty well. Um, Various financial services, various other types of services were generally doing quite well. And so you had that big gap of performance. And ironically, now what we're seeing is a little bit of a rotation. So some of those services seem like they're starting to exhaust themselves a little bit after a pretty strong period. Whereas those PMIs, those manufacturing type of areas, seem to be reaccelerating. They're still at a pretty low level, but they look similar to how they look when they're emerging from recessions or emerging from near recessions. And so I wouldn't be surprised if we see that the next, call it 18 months, is kind of an opposite story of some of these more cyclical areas kind of outperforming expectations, while some of these other areas that have done well over the past 2 years start to lag. And we see that in, for example, there's weak EV sales, electrical vehicle sales. There's a little bit of weakness happening in restaurants now. There's a little bit of weakness around the margins in some of these higher end categories that have been doing quite well, and a little bit of that rotation that's happening. That's kind of the main lens that I see it. We see it somewhat similar out of China. That's obviously another big macro impact on the global economy. They've been fairly weak for the past couple years, but they are showing kind of early green shoots, kind of early signs that they might be stabilizing at these low levels. Largely because of their policy shift. And so I think that some of these cyclical areas, whether the US or elsewhere, are probably starting to turn up even as other areas soften.
After analyzing the recent trends in the market, finance expert Lyn Alden delves deeper into the dynamics affecting asset classes like gold, Bitcoin, and stocks. Despite historically high bond yields, gold has shown resilience, signaling underlying fiscal concerns and a lack of confidence in traditional safe haven assets. Conversely, some stocks like Costco are trading at exceptionally high valuations, raising concerns about potential overvaluation in certain sectors. Alden believes that while gold and Bitcoin still have room to grow over the next 2 years, investors should remain cautious and look for undervalued sectors like energy and other cyclicals.
I would say that the rise in gold, even despite the fact that rates are this high, including official measures of real rates being this high, has been kind of very powerful. I think it's been the biggest dislocations in recent years, and that's indicative of fiscal problems. I think that supports the fiscal dominance narrative. Um, for most investors, if you showed them the PMI chart that I mentioned before, that's basically like a sine wave of cyclical economic activity. And normally, when that's going down, bonds are doing quite well, meaning that their yields are falling and their prices are going up. So generally, if you just over the past 40 years always bought bonds when PMIs were falling and always bought stocks when PMIs were rising, that would not be a terrible investment strategy. And yet, what we saw over the past couple of years was as the PMI fell, bond yields went up, meaning bond prices sold off. Bonds acted very differently to how they normally act in a kind of when the cyclical side of the economy is weakening. And I think that's largely because of how much issuance has been coming to market, meaning how large those fiscal deficits are and how sticky inflation is, partially because of those fiscal deficits. And gold has been kind of sniffing that out, or the gold market, because normally when you get that sharp burst higher in yields, you would normally expect more gold weakness. But I think the market's seeing through that the federal government's kind of in a fiscal tailspin, meaning they don't have a lot of levers they can pull to get overall interest expense down and to get their budget deficit kind of more under control. And so I think that some of these real assets are holding up better than we'd expect based on the things they normally correlate with because they're forward-looking enough to see kind of how trapped some of those markets are. So stocks up, Bitcoin up, gold up, despite fairly high bond yields, is kind of indicative of investors not really wanting to be in the bond market and kind of going into a variety of other asset classes. I do have concerns around some of the equity valuations because, for example, there's been a strong what investors perceive as a flight to safety. So, for example, Costco is an incredible performing company. They grow like clockwork, very smooth, very high performing compared to their category, but investors are paying like 50 times earnings for Costco. And it doesn't really have the growth to normally justify that type of valuation that's way higher than it normally has as a valuation. So it's like investors looking around and saying, I'll buy Costco at almost any price rather than what I'm seeing in the bond market, rather than what I'm seeing in the cyclical market. And I think that's overdone. So I think the areas that are still kind of interesting from an investor perspective are ones that are not overvalued and haven't really gained a lot of that monetary premium yet. So, for example, the energy sector I think is still very cheap. Some of the other cyclicals I think are still very cheap, whereas some of those more kind of low volatility growth stocks I think are kind of overdone. If I were to guess, I would say gold and Bitcoin I still think have quite a bit to run over the next 2 years. But of course, every asset class is any sort of time frame estimate is mostly probabilistic because you're trying to account what other investors are going to do with their money.
In today's discussion, Lyn Alden provides valuable insights into the current state of the economy, highlighting the challenges faced by various sectors amidst rising inflation and fiscal concerns. Alden emphasizes the impact of fiscal deficits on asset classes like gold and Bitcoin, which have shown resilience despite high bond yields. Additionally, she notes the unusual behavior of bonds in response to economic indicators and warns of potential overvaluation in certain stocks. Looking ahead, Alden sees opportunities in undervalued sectors like energy and cyclicals. Remember, staying informed is key to making sound financial decisions.